Well, you're watching the newsroom here on ET Now. I'm Ajaya Sharma. The markets are coming under pressure, variety of factors, but one of the factors which is making emerging markets like India quite nervous is the sharp rally in crude oil prices. Apart from, of course, what the Fed commentary and higher for longer narrative is spoiling the mood for risky assets globally. But crude actually became a spoil sport for India, a very large, a billion barrel plus kind of a usage every year, when it rallied from 85 to almost knocking the $95 mark. So we thought of getting you someone who's a global authority on energy and crude oil and is a very regular and an old-time contributor on ET Now, but this time is joining us after a long while. I'm talking about Dr. Fereidun Fesharaki, who's joining us today on the show to explain what exactly is happening in the world of energy. Dr. Fesharaki, good afternoon here from Mumbai. Thank you so much. It's so nice to see you on the channel after a long while. I believe you've been very busy and traveling all across the world. Well, there is so much happening in the world of energy. Why shouldn't you? People may be seeking your opinion everywhere in the world. But glad that you are here with us today.
Thank you.
Dr. Fesharaki, let's start by trying to understand the most simple point right now. There has been a pretty unexpected sharp rally in global energy prices, particularly crude. And they're saying that it's mostly to do with tighter supplies. What's triggering this end of the rally and tight supply conditions?
Well, the first thing to keep in mind is that it is, after all, supply and demand on the one hand, and the other hand is sentiment and fear. As far as supply demand is concerned, the demand side is very strong. The demand this year is 2.4 million barrels per day of growth, of which probably two-thirds of it still is COVID recovery. And out of this total, 65% is in Asia. And from the 65%, half of it is China. So China is still very, very strong. But this is the last year of COVID recovery. Next year, it will have to be based on fundamentals alone. Fundamentals alone will show a demand growth of about 1 to 1.2 million barrels per day. But the COVID recovery has doubled that. So the demand side is very strong. On the supply side, OPEC Plus has been very diligent, and they've been holding the supplies back. They want to see the prices in the $85, $95 range. And we are close to $95. It probably is going to stay between 90 to 95, maybe a little bit below 90, but I doubt whether it would be 100 or not. But on the other hand is the concerns about the financial markets. Worries about recession, worries about the Federal Reserve rate increases. And every time one bank goes bankrupt in the US and Europe, then there is all negative sentiments as far as oil price is concerned. But actually, the fundamentals are pretty sound as far as OPEC is concerned.
Okay, I'll go back on that point once again before we move forward. What, to your mind, Saudi Arabia and Russia's stance to really extend the voluntary cuts by 1.3 million barrels a day, what triggered that? Is it the urge to gain more market share in a world which is kind of weakish on the demand front overall? What, to your mind, and could it go beyond December as well, in your view?
Well, it depends on what the assessment of mainly the Saudis are, that's what the market will do. I mean, let's assume the Saudis decided not to extend the voluntary cuts. The prices would have probably gone down to mid-80s. So the Saudis want the prices to stay strong because they worry that all of those fears about this negative sentiments about the financial sector would intervene and make the prices go lower. So they would like the 85 to 95, and they are pretty much there already. Question is, what happens next year? And next year, we think the demand growth will be much smaller than this year because the COVID recovery phase is over. The OPEC says that still expect 2.4 million barrels per day growth. many people, including ourselves, think that the demand growth will be maybe 1.2, 1.4 million barrels per day. If indeed the demand growth is lower, then OPEC needs to continue to cut back. And how far are they willing to cut back? And will everybody participate or not? This is something that is yet to be determined.
Net, over the next 12 months, what range do you see Brent crude trade in, on the upper side and on the downside?
I think on the downside, probably will not go below 80 because the OPEC Plus will not allow it by trying to control the market. But there could be downward pressure on the market because the demand fundamentals are not going to be the same next year as this year. So the big question is, are they going to continue the voluntary cutbacks into the first quarter of next year or not? I think even the Saudis are not decided yet. They're going to wait and see how the market is performing. If they find that the demand is actually as strong as OPEC says, then they might maybe cut it from 1 million to 500,000 for a few months and then remove the voluntary cuts. But if the demand fundamentals is weak, I think Saudis would have to ask every OPEC member to participate in supporting the price because they are not going to be the swing producer and be the only one who is cutting, and while everybody else is watching and enjoying the price increase.
Right. Dr. Fesharaki, how are you looking at the economic condition, the prevailing economic conditions in two of the large energy consumers in the world, US and China? Because the Fed has tried to engineer a slowdown in order to rein in inflation in US. China is going through its own economic issues and inward looking. But the fact of the matter is that both on economic trajectory have been on the weak footing. Do you see it stabilize? Do you see it weaken or persist this kind of a sagging growth there?
Actually, U.S. economy is doing pretty okay. China economy has been weak. U.S. economy is really the way to assess it to look at the unemployment numbers. Unemployment in the U.S. is at record low. And if you want to have a recession, first thing that you need to see is rising unemployment numbers. And certainly there is no evidence of that at all in the US. Oil demand is still on the growth path in the US. Gasoline is still growing, but we believe that it's almost to the ceiling and that it will flatten and slowly it will fall. In China, the service sector is doing very well, but the industrial sector is doing very poorly. And so the property sector also doing very poorly. So all of these things together cause fundamental worries. But if you want to compare this year, Chinese demand growth is 1.3 million barrels per day. Indian demand growth is 200,000 barrels per day. So India is now still 1/6 of China. And for many years, the world depended on Chinese growth coming and saving the oil market. Everybody in OPEC was counting on it. But the reality is that while Indian demand growth has prospects for growing even higher in future years, the Chinese demand growth will come to a peak within 3 to 4 years. And oil demand will peak in China faster than anywhere else. Oil demand in, as far as India is concerned, it can continue to grow for many more years, way into the 2030s.
Mm-hmm. Dr. Fesharaki, let's take the discussion slightly more broader, but focusing on energy. How are you observing the energy transition trends globally? As you may have well observed that in this G20 meet as well in New Delhi, a lot of global premiers and the energy transition was the area of focus. It is the area of focus, and there's a lot being done. How do you see the progress around it so far?
Well, the progress in Europe is very serious and severe. In US is slow, mediocre. In the rest of Asia It depends on economic growth. I mean, certainly, India still continues to use more and more coal. If there is an energy transition plan, I certainly don't see any fundamental signs for it as India is concerned. In China, the EV is becoming very, very big, but EVs in China are based on coal. So actually, EVs in China, they emit more carbon than gasoline does. So I don't know whether that really is helping the world situation or not. So we have to separate emotions from reality and separate what the Europeans do from the rest of the world. The Europeans are basically look at these issues as a religion, and they do whatever it takes, spend as much money as it takes, and they don't care if it damages their economies, because they are all wealthy countries. But in Asia, the situation is different. Asia still has growth. People have to worry about poverty. People have to worry about energy poverty a great deal. So they cannot go the same way as people do. So G20 may give pronunciations or pronouncements of what to do, but actual actions is going to be much, much slower than what people say.
And in that same vein, just a quick opinion from you on the India, Middle East, Europe corridor, which is being proposed now, new Silk Route of sorts, which is being spoken, and with the hope that in future energy trade could also happen, be it electricity, be it green hydrogen. What could be the challenges to such a large project with the future of trading large amounts of energy on that route? Any thoughts there?
Yes, I think it's more talk than action. It's good strategy. Sounds nice about this energy corridor, but India's demand growth is what it is. As far as oil is concerned, by having a corridor or not having a corridor, it's not going to impact the growth. In terms of hydrogen, yes, green hydrogen is going to be very, very expensive and can only work with huge subsidies. Now, in Europe and in the US, they are throwing trillions of dollars of subsidies to this. But certainly in India, nobody is going to throw trillions of dollars of subsidy to it. So you have to wait until the economics of it shows itself. So having the corridor open, that doesn't mean it's going to happen. Economics must dictate that it can happen, then it will happen. And I think we are still a good 10, 15 years away from the times that the economics of green hydrogen are positive as far as India is concerned.
Dr. Fesharaki, just one last word. There is one section, the big advocates of green energy say that green energy, electricity, all of that is replacing traditional sources of energy at a very fast pace. There's one section say that legacy energy sources are not going away in a hurry. And the realists say that both are going to stay together for some time before the renewables take over in a major fashion. And this sometime could be at least a decade or so. Which part are you, more tilted towards?
Certainly towards the last one. They have to grow together. But I mean, basically, in 2019, right after 2020, when COVID started, many companies like British Petroleum said that oil demand has peaked already and is going to continue to fall. Since that time, the oil demand has grown by several million barrels per day. And as I mentioned earlier, 2.4 million barrels per day this year, and between this year and 2030, another 8 million barrels per day of oil demand will be seen around the world. So it's certainly not going to go away. And a decade is not enough. We need 2 or 3 decades before renewables can start to replace fossil fuels. Oil demand will peak in 10, 12 years. Gas demand, probably another 25 years, 30 years. And coal, the countries in Asia, particularly China and India, will continue to use it as long as the economies need it and the people need it. Just to join the crowd and look like a good citizen, I don't think anybody is going to go and cut back fossil fuels. There is no evidence of that. So I think we're talking about 15, 20 years before we have any substantial change. And please remember that a lot of the electricity supply is going to be impacting the power demand. For now, still, EVs are relatively small, and our dependence is very much on the on oil, gasoline, and diesel for mobility.
Right. All right, Dr. Fesharaki, thank you very much for joining us today and sharing your thoughts on a variety of issues. But the gist remains that the crude oil prices may remain elevated for some time, but there could be a cap on around $95 where we are right now. Low probability is what he is assigning for crude oil prices to cross 100, but at the same time, it may not go below $80 as well. And of course, a host of his opinion around renewables and green energy.